investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. On Friday, I run this podcast called, I don't know what it's called to be honest, it's episode 19 anyway. So I'm calling this one Volatility. And essentially, what happens is that on Fridays, I kind of, for about roughly 20 minutes, I kind of go through and talk about some kind of topics of interest for right now, and I also talk about some kind of evergreen topics. The idea here is that by me kind of sitting down in front of you and like providing some kind of knowledge, a source of ideas, a different side, a different perspective, I'm also having to learn and kind of dig out and find interesting things that are worthwhile talking about. It's really something to be kind of enjoyable, but also that you'll be able to learn from it as well. I asked last week if people felt that approximately 20 minutes was was a good length to go with this, and you ask two people and you get like three opinions. So some people said, they'd like it longer. Some people said it was just right. Other person said, 5 or 6 minutes would be great. And I'm like, 5 or 6 minutes is really concise. You ultimately just saying, kind of buy low, sell high. And I think that's, it's basically, I'm just going to go for about 20 minutes. And if I see that the feedback is that people kind of want it to be closer to 30 minutes, I'll kind of adjust them. Okay, so we've got three topics for today. We're going to talk about the volatility in the market right now, obviously. Earnings season is a very exciting period for investors. We're going to talk about the single best investment strategy. And then we're going to talk about calls from the sell side. So, what that actually means. So, I hope that this is going to be kind of interesting for you guys. Okay, so here's the thing, right? The volatility in the market the last, few weeks has been really, really crazy. Now, these people often imply a sell-off with volatility. A sell-off is not the same as volatility. Since approximately November, the market has been consistently selling off in an unrelenting, dispassionate way. That is not the same as volatility. The sell-off has been quite consistent. It's been like, it's not been up days, it's just been like consistently getting hit in the face. So it's no volatility really. This past week, right now, starting kind of, I'm recording this on the 4th of February. It's going to be approximately 9 a.m. Eastern time by the time this is uploaded. The volatility this week has been crazy. Up, down, wow. It's like this has been crazy. That is like highly volatile. And George Soros has made this point in the past that when there's a lot of market volatility, it's the market telling you it's looking for a direction. It doesn't say whether it's going to go up or down. He's just saying that the market is looking to change direction. And if you look back to my episode last week I said we are now towards the bottom. I said that I don't know how things are going to go from here, but I'm very much inclined to believe that from this point over the next 2 years, things are going to go and improve much better. And I said in last week's call that at the bottom of the sell-off, when the market's kind of just selling off, the bottom is kind of that last little, kind of the market just like, everyone just like, just take my stocks. And I saw that, so if I rewind the clock now, so I record that on Friday, and if I rewind the clock to the early start of, I think it was Monday of that week, when the market opened, it was just like countless stocks down 12, 13, 15%, countless. And that was in the first hour, so it's just like, and then it kind of, the market kind of, the algos kind of started picking back up. It still ended down approximately 5 or 6% most stocks, but when I'm referring to most stocks, I'm only focused really on small and mid cap stocks. I'm not really focused on like, what the large caps are doing. That's their problem. But I don't think that I have too much to add there. I don't have enough of an edge there to kind of really out battle like an army of people. But anyway, so I think that we're kind of in this period where things are kind of changing direction. I think, I'm an optimist, and I really believe that, we're kind of over the brunt of it. I think that things are going to start stabilizing, and I really think that I continue to say that, from this point right now, over the next 2 years, investors will be really rewarded. And I know it's difficult to believe that point right now. It's really difficult to believe right now that things are going to get better. And that's the thing. It's not going to be a smooth line. Stocks kind of, the returns are going to be bumpy. And but this is a really good buyer's market. And I know it sounds difficult to believe, but this is the best thing that you got to do when you look to buy into the market. Use the time to leverage into your ideas, to lean into your ideas. Don't let the price points, okay, the market's down, I'm gonna go in, double down, double down. Don't do that. That, you know, you're gonna get yourself overwhelmed, and that's just unprofessional, poor discipline. You need to be in a focused state of mind to just kind of every so often, you know, let time lead your progression into these businesses. Understand the businesses you own and be committed to those businesses. I think that this is something that I, you know, every time I talk about it, it's really, really important that you think in your mind like a business owner. I am the owner of this business, and just thinking to yourself, okay, the example that I always give is about you. If you go and buy a property, you kind of go around the neighborhood in the daytime, in the night, and you kind of get a feel for it. But it's only really when you move in to the house and you've been there for a little bit of time, you kind of start understanding that the neighbors are XYZ, you know, and that the sentiment there, and it's a bit odd with our cars by the side of the road. You start to really understand a house when you've been in the house for a period of time. And the same with this with a company. You can know only so much from the outside, and you can be the biggest fanboy of Apple, but until you've owned a share of Apple and you've held on to it, and you're the business owner, and you're thinking like a business owner, then you can really understand what's ultimately driving that business. And that is not something that's going to come overnight. That's going to be something that you're going to learn over time. So when you look to average into your positions, let time lead your way. So yeah, okay, that's one thing I want to highlight. And this leads me to the second point, right? So the single best investment strategy is often learning to just sit on your hands and do nothing. And that sounds like such a cliche, I mean, but it's so true at the same time, because it's not really about picking the best stock. If you're just looking, like I am, to compound your portfolio at approximately, let's say, 15% per year, you don't need the best stock. You don't need to find the next Tesla. You don't need to find the next Netflix. You don't need to do any of that. All you need to do is just sit on the business and let, you know, the business compound. I'm not saying buy and hold for the next like 10 years. I'm not saying that, you know. I'm not even saying buy and hold for the next 5 years. I'm just saying there's a big difference between buying a business, sticking around with it, let's say for about a period of, let's say, 18 months, and, you know, getting to know how the structure is going, see developments, then kind of in this quarter, out last quarter, oh, the analyst said this and the analyst said that, so I'm going to be in and out. Like, that's going to lead nothing to nothing. You know, it's just about buying the business and letting that business compound over time. I think that that's really, really important, and that's really, really difficult to do. And there's so many studies to show that, you know, that the best investors, investors are often the investors that have actually passed away. You know, they just kind of bought the stock, they just forgot that they had it, and those dormant brokerage accounts do really well because they're not influenced by emotions. They just kind of, you know, they forgot about it and just let the business compound. That's not going to say that the returns from those businesses are going to be like the eye-popping ones that journalists always talk about, but the returns are going to be more than satisfactory. And that's really, really important. It's really, you know, to have that mindset, to be clear in your vision of how you invest. And I think that, you know, that gets kind of thrown out a lot nowadays. And because people have so much quick access to kind of buying and selling stocks, and you can do it from your phone, people have the urge, you know, to react. And I say, you know, I know it's difficult, particularly right now when we're just like in crunch time. You feel that, okay, that stock that I've held is a loser stock, and I'm gonna get rid of it, and there's gonna be another stock. Oh, that's sizzling one. It's sizzling. I'm gonna go for it. And, you know, I can't express it in any other way. That really just having a tiny bit more patience and sticking around with your business. I'm not saying that you have to buy your business and hold, you know, for more than 2 years, but a lot can be reflected of the company's fundamentals over a period of a year. Over a period less than a year, you know, it's anyone's game how it performs. But giving the business the ability to not only have a vision, start to reflect that vision in the fundamentals, and for the market to start seeing, okay, because the market's always forward looking by another year. So you kind of, just giving things time a little bit. I think that's a really attractive strategy to just to think through. Okay, the next topic that I wanted to kind of talk about today is this. So a lot of people say to me, oh, you know, I hear these kind of names: buy side, sell side. What does that all mean? So the buy side, as the name entails, are the portfolio managers, the pension funds, people that buy the stock. The sell side is the people that write all the noise. Price target, Tesla, 5 billion and free, whatever. Like, that's the sell side. Those people that are just giving out these kind of price targets, you know, to a certain extent, I suppose me, I run a marketplace where it's kind of I write research. I would be considered also the sell side. So anyone that's kind of offering insight into what what people should be buying is the sell side. You can also take that a step further, and you can look at, for example, investment bankers. When they facilitate the way that companies can raise capital, that's also part of the sell side. So the sell side's business is really to just make it easier for companies to have liquidity, really, in a sense. I think that's kind of a helpful way to think about it. Now, what is quite interesting here is I was reading this book, Lessons from Titans, and it's a really cool book. It hasn't got a large following on Amazon, and it's fascinating. So, like, I think it's like the first chapter, I can't remember, maybe the second chapter. There's an analyst, and he's talking about how he's talking about General Electric in the approximately 2000 to about 2017 or something like that, and that he's covering the company. And anytime that he kind of gives a less than favorable, outlandish kind of buy target on General Electric, he gets a lot of abuse from the management of General Electric. They kind of phone up his company, I think it was Morgan Stanley, that he was working for, and tried to get him fired because it was like that he was being called anytime they kind of asked a question, that wasn't to the liking of management. They would, for example, they would not only, they'll be really aggressive. They would say that he was being rude or unprofessional, and these kind of things. And it obviously, the analysts, what they're trying to do is, as best as possible, try and understand, try and provide insights to where the company is going. And if they believe that the company is not doing very well, in the kind of best case scenario, they'll kind of give you a reasonable estimate of why the company is not going to do well, or but they just get punished for that. So you see a lot of people they just say hold, or market perform. Market perform is just another way for this thing is going to die, but it's kind of an interesting thing. So just to see how the game is so biased, and I mean everyone knows these things, but it's just interesting to see how the game is so biased, and you're only gonna hear good things from analysts, and they kind of go on CNBC and they say that the company is doing X, Y, Z, and this and that, and it's like, I mean, it just seems so difficult out there to kind of get any kind of sense of how people actually feel, because ultimately the analysts, they have much more contact with the company. They're able to sit down a few times a month probably with the CEO of a company, or depending on the size of the company, might just, some of the delegates, like once a quarter or so, depends, but they kind of have that kind of very close like time with the management team, and they can speak through and understand different lines of the financial statement, really get a very up close and personal feel about how the company is performing, that you, as no matter how clued up you are about, let's say, Apple, you have no idea. I mean, you're just going to see the quarterly result, and it's going to be, a bit of a shocker to you, whether it does bad or good. But that's the that's the thing with markets. You have to take some kind of idea, and you have to try your best to see where the company is going to be in a year's time, and you hope that you are not overpaying for that, and you just learn to sit around and just wait for that compounding to work. But anyway, so I think that's kind of interesting. Since we talk about mega caps, I think it's quite interesting. Just going to put it out there and see what people say. So Amazon reported some numbers. I haven't spent a lot of time going through this, but I just kind of skimmed through. And they're guiding to be up next quarter approximately 8%. And I'm thinking to myself, the market went absolutely bananas yesterday after hours, like up 17%. And I'm like, wow, really? I mean, maybe it's just me. I mean, maybe it's just me. Maybe I don't get it probably. But I'm like, that's not a lot of growth. I mean, there's a lot of companies out there that are growing substantially faster. And I know the spiel. If you're an Amazon shareholder, you're gonna say, Michael, you don't understand that they're investing for growth. I've heard this. Listen, I've been following Amazon for years. I've been writing about it consistently. I know the spiel. Investing for growth. I've heard you, but if you're not delivering more than double-digit growth, where is the growth? I mean, it's just kind of these things. I don't know. And I know what people say now. Now it's all about high margin AWS. It's like AWS is gonna take over the planet. I'm like, okay. AWS was up 40% year over year. I look at Google, it was up 45% year over year. I look at Azure, it was up 46% year over year. So, the other competitors actually taking market share from AWS. So, it doesn't make a lot of sense to me. Also, you got to remember that the bulk of the revenues that Amazon makes is from the retail side, right? Yes, AWS is amazing. I was like, oh my God, it's amazing. But it's a fraction of the actual retail side. So you got resale side, and then you split that up and you got like North America, and you got then kind of, let's say, Europe. And Europe is barely profitable. And I know that the North America side is kind of, much more attractive, and it's much more sticky, and, they've been able to increase their prime costs and stuff like that. But if you're going to talk that, you're buying Amazon because of its AWS side, just put a multiple on the AWS side, and then you kind of see what's left for the retail side. And I know that I shouldn't be really speaking this, because a lot of people kind of don't listen to this. They really buy and hold long-term shareholders of Amazon, and you shouldn't really kind of go against the crowd like that, like Joe Rogan did. And I kind of sometimes these things just come out. I shouldn't really say these things. But anyway, I just find it's quite interesting anyway. Just one more thing that I wanted to highlight was also this week about how the whole news about Meta. Oh man, so that's an interesting one, right? So I was just looking at these numbers, and I get the point, right? And I get that Meta, they're not being able to measure their adverts as well, and obviously advertisers don't. If you can't measure the ad, advertisers are like, how do I know the success of the ad? I'm not going to pay you as much, because my ROI, my measurable return on investment, is going to be lower, so I'm not going to pay the premium that I was used to paying for Meta. So if my ROI is lower, then Meta is not able to have pricing power, and they also talked about at length about the level of competition, also taking some of the volume away from its own platform. But they do get over this. Like, they have a long history of innovation. It's an A-class team, and when I look at this free cash flow, it was up approximately, I think, 65% year over year. And I'm thinking to myself, wow, this is a lot of free cash flow. If you say, for example, that Meta's free cash flow grows by approximately 15% over the next year or so, you're getting close to 44 billion of free cash flow. And then I think to myself, okay, at 50 billion, which is not a big difference in 45 and 50 billion, at 51 billion for the trailing 12 months, you got Microsoft. The Microsoft is priced at approximately 2.6 trillion. And I'm thinking myself, wow. I'm not saying that Microsoft isn't a great company, but I'm just thinking myself, like, it's possible that there kind of is a bit of a discrepancy there, because one company is, yes, it has hit a bit of a hard time, but it makes free cash flow like nobody's business. So I'm just kind of thinking myself, like, this market's a bit nuts. Anyway, I hope that you found this kind of useful. I kind of waffled a little bit today because I just had so many things that I wanted to bring to you. It's a really interesting period right now with the earnings season. Is just really, really cool. That's really what we're all about here. Like when it comes to investing, it's all about this quarterly results. And yeah, so if you want to find out what kind of names I'm buying right now during this earnings call, obviously I'm going to tell you. Don't forget to check out Deep Value Returns. And yeah, if you could, please drop me a like, because that really motivates me to come back next week, and people have been really kind and supporting, and I'm really grateful for that. So thank you so much for your time, and I hope to see you next time. Bye.